Those of you who know me really know that I love collecting coins. So in this hand, I have a seated Liberty dime, and in this hand, I have a Mercury dime. So if I put them together, I have a pair of dimes. But it's not about a pair of dimes that I want to talk about today. I want to talk about our paradigm for retirement. So, paradigm is a concept or thought pattern. And it is really this paradigm that drives how we will prepare for retirement. You won't want to miss today's video. Hey guys, Kevin Burgess back again with another video, and I would love to talk today about our retirement paradigm. I want to share with you today about my paradigm, how I look at retirement, and hopefully you'll find it useful and you can use at least some of what I share with you today building your paradigm for your retirement. So, what I call my paradigm is the pension style income from my portfolio. If I take the first letter of each of those, it spells out the word pimp. So, we're going to talk today about how we're going to pimp our retirement, how we're going to pimp our portfolio, just like they would do Pimp My Ride on those TV shows. So, we're going to pimp our retirement portfolios today. So, let's get started. The foundation of our paradigm is about wealth. Wealth is needed to be able to pay for expenses as we age. Our wealth can be made up of a couple of things. It can be stocks, it can be real estate, rentals, it can be collectibles and things along those lines. But why do I need that? Well, first of all, just think about what we're going to experience in retirement. We're going to experience the need for income because it is that income that will pay our expenses, resulting in discretionary income. So when I think about my retirement, I like to think of discretionary income similar to the residual cash flow of a business. And one of the things we look at when we are investing in companies is what do they do with their excess capital? It's called capital allocation. So if we're looking at that for a company, it's important for a company. Why shouldn't it be important for us in our retirement? So as I think about retirement income, I think about stocks, real estate, collectibles, kind of feeding the income portion of our portfolio. I recognize that there are other things like maybe pensions or Social Security, but I'm going to leave those on the side for now because we're talking about investing here and we're talking about a portfolio. So I'm going to leave those off to the side. So it is our income that pays for our expenses and then results in discretionary income. That discretionary income can result in our ability to do the things that we enjoy, like travel and entertainment, our hobbies, but it also needs to create the ability to reinvest in the portfolio. So the question is, why do we want that? Why do we really need to reinvest in our portfolio? We're in retirement. Why do we need to reinvest? In retirement, our expenses are going to go up. I mean, take a look at this chart from the Fed. You can see that, and this goes back to around the year 2000, and you can see all of the every year since the year 2000, prices have gone up. So the things that we're buying to live have actually gone up. We need to be able to combat these higher expenses. If you think about travel and entertainment, if everything's going up, fuel's going up, lodging's going up, airline tickets are going up, eating out is going up. So all of our travel and entertainment expenses are going higher as well. We can even conclude that our hobbies are going to be more expensive. The things that we enjoy doing are going to cost more to do. So we need our wealth to create higher income so that we can cover these higher expenses. And I tend to think of this in my paradigm in two different ways. One is the expenses that are going to go up year after year, and the other is there are going to be expenses that I don't even know about today. So, how do I handle both of those in my investing portfolio? One is I look for my dividend or rental income CAGR, which is the compound annual growth rate. I look for that to at least match inflation. So if that's matching inflation, then my income from those streams of cash is actually keeping pace with the cost that's going up for my expenses. But what about the expenses that I don't even know about today? And what are some of those? Well, some of those could be healthcare. As we age, we will probably experience higher healthcare costs. We don't know what taxes are going to be in the future. They could go up, which would actually result in less discretionary income for us. So we need to have the capability of covering these types of expenses. So what are the pros and cons of this PIMP model? I mean, why does it even matter? So I've had some discussions lately about folks who are putting their money in high yield savings accounts, and so they're risk averse, which is fine. There's nothing wrong with being risk averse, but I wanted to compare what it would be like if we took the last 10 years of performance in the stock market with good quality dividend growth companies, comparing that with what we would get if we put our money into a high yield savings account over that same 10-year period. But before we get to the charts, let's take a look at the pros and cons. First of all, the pros of investing in the market: you have the potential for higher income. There, you can keep pace with inflation better, you can cover unforeseen expenses, and you can improve your lifestyle. Investments grow long term. This helps me with the question, do I have enough? Because if I don't have enough, and I encounter something I was not expecting, will I have enough to live out my life? And one of the pros of having a pimp model is that you will be able to better cover costs that you don't see today. Also, it sets our heirs up for success because with a pimp model, I'm not expecting to run out of money before I die. And then also, it leaves a legacy. So, we can really create a legacy for our families. What are the cons? Well, it's inherently more risky. It's inherently more risky than putting your money in a high yield savings account. Why is that? Well, you have the ability to lose money. And in a high yield savings account, your principal is protected. So it's inherently more risky. It also requires care and feeding. I mean, think about investing in the stock market. You want to keep track of your companies. You want to listen to annual reports. You want to listen to quarterly reports. You want to read news about the company, and you want to manage your portfolio. All of that takes time. So it requires care and feeding. That is a con. If you just put your money in a high yield savings account, you stick it in there, you get your interest every quarter, and you are good to go. But what are the results? So let's look at a visual comparison here of the two approaches. Now, just for clarity, none of this will be exact to what will happen in the future. This is simply a model, and I've taken what I believe about the future of high yield savings, coupled that with what the actual performance has been over the last 10 years for the popular ETF called SCHD. So, assumptions are that the high yield savings interest rates will decline over the next 10 years. Why is that? Because it looks like that is the direction the Fed is heading. They are saying they're going to reduce the interest rates, which will reduce the amount of money that will be yielded off of our savings accounts. Also, another big assumption is that the next 10 years in the market will look like the last 10 years. And I will be the first to tell you, I don't know what the next 10 years holds. But I look at the last 100 years of performance of the stock market, and I have confidence that the stock market will continue to perform in the long run. First of all, let's take a look at this bottom chart. This bottom chart is the wealth comparison. So as I look at SCHD, the value of the holdings, the investment, the core principal in SCHD went up over time. Now you will notice that in year 1 and 2, from year 1 to year 2, it went up, but year 2 to year 3, it went down. Year 4 and year 5, it went up, but year 6, it came down. So I want you to know that there is volatility that you would experience in the market. Look at the savings account. It is the steady Eddie, $1 million, because its principal does not grow. It does pay interest, and we'll talk about that in a second, but it does not grow in principal. However, look at this. At the end of year 10, the value of the stock portfolio was somewhere north of $2.5 million, where the where the high yield savings account was somewhere in the $1 million range. Now let's take a look at the income on an annual basis. It first starts out pretty even year one and year two, but then in year three, it begins to pull away. The stock market begins to pull away. Why is that? Well, first of all, dividends are growing on an annual basis, the companies that we're selecting. And then secondly, our portfolio value is growing. So therefore, our dividends are growing also. So we started out with around 50,000, and my expectation is that interest rates come down. I'm assuming they'll eventually hit around a 3.5% range. So that's kind of where I've left it. Went from 50,000 down to 35,000 for the high yield savings accounts. But look at the income for SCHD. It went up to around 200,000. So if you're looking at the future and you believe that you're going to incur higher costs in the future, costs that you don't know about, the high yield savings approach is a bit scary because you could end up in a place that you don't want to be, which is not having enough money at the end of life. So I believe a great approach is the stock market approach, and I wanted to share that with you guys today. We talked about the pros and cons, but you have to be ready for volatility if you're in the stock market. If you can't handle that, then stay with the high yield savings approach. But if you can handle that, if you believe that you can handle that, it is worth trying the stock market with high quality dividend growth companies. I believe that is a wonderful way to make sure that you have the ability to cover not only inflation, but also those expenses that you are not going to know about when you retire. So if you like content like this, consider subscribing to the channel. I'd love to have you along for the journey. If you want to support this channel, you can do that through a link that I have called Buy Me a Coffee in the comments below. And then also, if you want to join a Discord community where we talk about dividend stocks, then consider subscribing to the Discord. That's also in the comments below. It's free to join. We'd love to have you there. It's a community that's about 100 people strong, and I'd love to see you there as we talk about how we're growing our wealth and our portfolios for the future. So with that, I'm going to get out of your hair, and I will see you on the next video.